welcome to Real Economy. In this episode, we are here in Paris and Amsterdam to explore ways to get our economies out of stagnation. The European Central Bank has been leading this challenge for years, but some say that now its financial toolkit is almost empty. So some countries are being asked to invest more, such as the Netherlands, and then we visit the chief economist of the OECD, Laurence Boone, to discuss what comes next. And this is really important for the small and medium enterprises, which represent more than 99% of all European non-financial corporate companies, and they depend on banks for 70% of their external financing. Let's see how they are doing across Europe. In the eurozone, SMEs' need for extra bank financing has reduced from 6% of GDP in 2015 to 3% of GDP in 2019. That is 400 billion euros. This is the result of record low interest rates on bank loans and higher bank loan availability thanks to ECB support, pushing up loan supply mainly in core countries. The biggest gap between SMEs' bank loans demand and supply are in the Netherlands, Belgium, France and Italy. At the same time, the highest increases in bank loan supply were seen in France, the Netherlands and Germany. This is a sign that banks in these countries are in good shape. SMEs in Greece are still strongly affected by the lack of access to finance. 1/4 of them says it is their most important problem. Also, Italy, Ireland and France have the second and third largest shares of SMEs reporting the same as their main concern. But the record low cost of borrowing is having another impact too, with property prices in certain European cities pushed to dangerously high levels. One of them is Amsterdam. Fanny Gore visited the Netherlands to see how local businesses and people are affected by this policy. Let's follow her.
I'm in the south of the Netherlands. Here in this plant nursery, we're also concerned about economic growth. The bond-buying program of the ECB, launched in 2015 to support Europe's economy, is helping SMEs get cheaper loans. It allowed this Dutch company to get off the ground. Special Plant employs 25 people. Recently, the company developed a local tea plant offering a greener way to consume tea. And to start the journey, Johan needed help.
For the plant business to start, the bank loan was really needed, and it was a big investment, in total of 1.8 million. So we needed a big amount of money with low interest. With the tea, we are also preparing to grow in each country. It's essential to have cheap money, because otherwise we cannot grow.
Bank interest rates in the eurozone are still historically low, which greatly helps borrowers like Johan, if not savers. The cash flow provided to the banks is also an incentive to lend to households, encouraging them to spend their money. Fenna recently bought her apartment. Even though the housing market has increased sharply in the Netherlands, the bank would finance only 45% of the transaction, but she was still able to buy her house thanks to help from a relative.
It is an opportunity for me because of the interest rate is so low. It's not that I earn a lot of money and I have to pay my mortgage, and that's really low right now. So yeah, definitely it's a good time for me now to buy a house.
This year, households had an outstanding mortgage debt with Dutch banks equal to 91% of the country's economy, compared to an average of 55% elsewhere in Europe. The Dutch central bank considers this to be one of the biggest threats to financial stability in the Netherlands.
The first risk is that the housing market will keep on rising and housing prices might feature bubbles. Second risk is that low interest rates do damage to the liabilities of the pension fund, and this is of course very bad for the Dutch economy. Low interest rates are a signal that the government should actually invest more, especially in education and research and the energy transition.
The ECB is calling for countries with budget surpluses such as the Netherlands to invest more in its economy to stimulate growth in Europe.
So not everybody agrees with that call from the ECB. The Dutch and German finance ministers insist that their governments are already doing a lot to boost domestic demand. There are clearly a few differences of opinion in Europe over spending, but let's meet now the chief economist of the OECD, Laurence Boone, to discuss where the sweet spot lies. Many thanks for being with us. And of course, I would like to start by asking you, has the ECB reached its limits over helping the eurozone to grow?
The ECB has set up rates at a very, very low level, but it has also given a lot of predictability over the path of interest rates. And we know that rates are there to stay long. The ECB has been doing a lot since the beginning of the crisis, but it has been the only game in town for too long, and that cannot last forever. Which is why we are arguing for fiscal policy to step in and help the ECB achieve its objective.
Who has to do more?
There are quite a few countries with fiscal space in the eurozone. There are obviously the Netherlands, Germany, a lot of Nordic countries, but you know, everybody has to invest in the technology, digital energy of the 21st century. Take the Netherlands. They have announced in their last budget that they would increase their budget spending by 1% of GDP, but even more importantly, they are setting up a fund of 50 billion, which will be, we think, partly financed by borrowing, to actually fund the energy transition, and that's what we want countries to do.
I would like to ask you about these warnings that we hear every day by economists, experts, many people, also from people, bankers in the ECB, that all this policy from the ECB is quite dangerous for creating bubbles. Are you also worried about that?
What we have done is to compare two policy mix. One where the ECB is acting alone, and one where the ECB is doing half of what it has done so far, and the other half is made up by fiscal policy. And what you see is that you get comparative GDP growth, you get more or less the same inflation, a little higher with fiscal policy, but even more importantly than that, with the optimal ECB fiscal policy mix, you have half the asset price inflation than we have seen with monetary policy only. So the message we're giving here is having a better policy mix not only deliver better growth tomorrow, but it also reduces the risk of having some kind of bubble.
So public investment from certain countries combined with low interest rates for some time more can give some breathing space to the European economy. So Mrs. Boone, many thanks for being with us. Thank you for watching and see you next year.